Here's the thing, nobody wants to say out loud right now, the world feels a little crazy. We've got wars, tariffs shaking, global trade, AI turning industries upside down. And if you're an investor watching all of this, you've probably felt that urge, that itch to do something, anything, to protect what you've built. But I want to tell you something right from the start. That urge, it might be the most dangerous thing for your portfolio right now. Stick with me, because today we're talking about how to actually manage your investments when everything feels out of control. And no, the answer is not what you think. The biggest mistake investors make. Let me start with what Julian Morris, a financial planner in Boston, told me, and this stuck with me. He said, the biggest mistake investors make is assuming they need to react to every headline. And he's right. A well-built investment plan is designed to handle uncertainty. It's not supposed to follow the news cycle. And look, history backs this up. The tariff-driven market sell-off we saw in 2025, stocks went off a cliff. COVID in 2020, stocks went off a cliff. But both times, markets came roaring back to new highs. Now, I know what you're thinking. What if this time is different? What if the next crash doesn't bounce back quickly? What if it drags on like 2008? Ben Howarth, a financial advisor in Connecticut, put it perfectly. Each crisis feels like the worst one because it's the one you're living through right now. That's not a dismissal of your fears. That's just the reality of what it feels like to be in the middle of uncertainty. Every crisis feels historic when you're inside it. Here's something behavioral finance research tells us, and this is wild. Investors feel roughly twice the pain from a loss as they feel happiness from a gain. Think about that. It takes a $100,000 gain to emotionally match the impact of a $50,000 loss. That's not rational, but that's how we're wired. And now layer on top of that the modern news cycle. Used to be, you'd catch the market results on the evening news or the next morning's paper. Now, it's a never-ending stream of alerts, headlines, red numbers flashing on your phone. Daniel Milan, an investment advisor from Michigan, said it plainly, we're emotional beings. We see the market flashing red and it triggers people. So what do? Marta Norton, chief investment strategist at Empower, gives advice that sounds simple but is actually really hard to follow. She says, put away your statements and stop checking daily. That's not how you judge the success of your portfolio. I know, easier said than done, but she's right. Now, the most common emotional response during a downturn is to move money to cash. It feels safe, it feels like you're doing something smart, but here's the problem. A loss isn't locked in until you actually sell. The moment you sell, you've made it real, and then you face an even harder question. When do you get back in? Julian Morris frames it like this. If investors move to cash, they have to be right twice, knowing when to sell and when to buy back in. And most people, they don't get back in until prices have already recovered. They sell low and buy high on the way back up. That's the exact opposite of what you want to do. Here's the number that really drives this home. From 1996 to 2025, investors who missed just the 10 best trading days saw their total portfolio returns fall by about 56%. 56%, just from missing 10 days. And those best days, they tend to cluster right after the worst days. Ben Howarth puts it simply, it's all about time in the market rather than trying to time the market. In fact, one Fidelity study found that some of the top performing accounts in their entire system belonged to people who had forgotten they had the account or had passed away. The best investors were the ones who did absolutely nothing. Okay, so we've established that emotional trading is dangerous, but I don't want to just tell you what not to do. Let me walk you through the actual risks that every retirement portfolio needs to be built around. The first one is market risk and what actually drives markets. Norton makes a really important point here. She says returns are driven far more by fundamentals, earnings, dividends, valuations, inflation, than by whatever's in the news on any given day. She also draws a distinction that I think is really valuable. She separates crashes driven mostly by fear, like COVID in 2020, where the underlying companies were actually fine and markets snapped back fast from crashes rooted in real structural damage, like 2008, where the financial system itself was broken and recovery took years. Today's environment, she says, may contain elements of both. Real economic pressure from tariffs and oil prices, plus political anxiety amplifying the fear, which is exactly why a balanced, long-term approach beats trying to guess which way the market moves next. The second big risk, and this one is especially important if you're retired or close to it, is what's called sequence of returns risk. And Howarth calls it one of the biggest risks retirees face. Here's the idea. It's not just about how much your portfolio earns over time. It's about when the bad years hit. If you take big losses early in retirement and you're simultaneously withdrawing money, you're selling shares at depressed prices. That leaves fewer shares to recover when markets bounce back. So what do? A couple of options. One, if you can, cover your essential expenses during a downturn and delay discretionary spending. Travel, renovations, big purchases, those can wait. Two, use a bucketing strategy. You set aside 1 to 2 years of spending in cash and you leave the rest invested for the long term. If markets drop, you pull from your cash bucket instead of selling stocks at the wrong time. Nandan Rao, a 6-year-old retired researcher in Delaware, does exactly this. He keeps a few $100,000 in cash and he uses it not just as a safety net, but to buy when markets look attractive. As he put it, it's helped me land some real bargains. Third risk, inflation. And this is the sneaky one. When markets fall, it's tempting to pull everything into cash and bonds. But here's the problem. You still need your money to grow faster than inflation because inflation is always eroding your purchasing power in the background. The S&P 500's inflation-adjusted return since 1957 has been roughly 6.69% annually. Cash doesn't come close to that. One solution that Milan points to, dividend-paying stocks. Blue chip companies that may not explode in value but pay you consistent, reliable income. Unlike stock prices, dividends from established companies tend to stay stable or even grow during rough markets. If you can model your dividend portfolio to generate enough monthly income to cover household needs, Milan says you won't be forced to sell shares. And the fourth risk, longevity. About 1 in 3, 6, 5-year-olds today will live to at least 90. Your portfolio may need to last 25, 30 years. That means you need growth. You can't just park everything in safe assets and call it done. The solution here is building multiple income streams, Social Security, pensions if you have them, bonds, annuities that can provide guaranteed income for life. When your essential expenses are covered by guaranteed sources, you can leave more of your portfolio in stocks for long-term growth without panicking every time markets dip. So what does all of this actually look like in practice? Rao, the retired researcher we mentioned, sums it up well. He said, "I don't react to market downturns or even upturns on a whim. I just held, and of course, it recovered in a big way." He keeps a diversified portfolio, reviews it with his financial advisor twice a year, and rebalances only then, not in response to whatever's happening in the news. For people building their own portfolio, there's a simple guideline called the Rule of 120. Take 120, subtract your age, and that's roughly the percentage you should have in stocks. So a 70-year-old would be about 50% stocks, 50% bonds, and safer assets. It's not perfect for everyone, but it's a solid starting point. Then set a rebalancing schedule once or twice a year. If a bull market pushes your 50 over 50 mix to 60 over 40, you trim the stocks and add to bonds to get back on target. You do this on schedule, not because the market scared you into it. Above everything else, avoid making major financial decisions during moments of market stress. Norton says it well. Sometimes you need to give yourself a breather. If it's important today, it'll still be important tomorrow. Vanguard research has actually found that one of the biggest values a financial advisor provides isn't picking stocks or timing the market. It's behavioral coaching, helping investors not blow up their portfolios during volatile periods. And Morris from Concierge Wealth Management said something I want to leave you with. One emotional response can set back a lifetime of hard work and saving. That's what this is really about. Not picking the right stocks, not predicting the next crash. It's about protecting the work you've already done by staying calm, staying invested, and trusting the plan. If you found this useful, share it with someone who's feeling anxious about the markets right now. They probably need to hear it more than you do. I'll see you in the next one.